We have a great group to do this for our discussion. First off, we've got Chip Perkins, who's raised $8 billion for emerging managers over the last 25 years. His perspective will be invaluable. We have Mauro Andriotto, who is part of SMC, a Swiss family office, and Hedeka Capital Asset Management, which also is in Switzerland and invests in emerging managers and digital assets. I'm very much looking forward to getting his intake. Dagmar Birker, who I've done this before with. Hello, Dagmar. So is the executive director of Novastone Capital, which takes a unique process to finding emerging managers and grooming them for success through a search fund. So we're going to learn about search funds with her. And finally, we have Michael Ashley Schulman, who is the Chief Investment Officer for Running Point Capital, a multifamily office with a strong wealth management and investment management skills. They do everything from financial planning to estate and trust planning, tax prep, consulting, insurance. He's a wealth of knowledge, and we're looking forward to chatting with him today. Before we go on too much further, I'd like to introduce myself. My name's Heil. I'm institutional sales for Pacific Premier Trust, a division of Pacific Premier Bank, formerly known as Pensco, for those of you who might be familiar. What we do is we provide we are non-fiduciary custodians that focus on custody of alternative assets through self-directed IRAs, private fund custody of retirement plans, broker-dealer, successor custodians, ESOPs, and several other things. Our clients are family offices, RAs, broker-dealers, ultra-high net worth individuals, defined benefit plans, investment platforms, and ESOP companies. But whenever you work for the bank, there's always a requirement for the mandatory disclosure. So give me a minute, I'll breeze through this, and we'll get on with our discussion. Information is for educational purposes. It is only intended as and may not be relied upon as tax, legal, investment, or other advice. Pacific Premier Trust performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult with your professional advisors for your specific guidance regarding your investments. Investments are not FDIC insured and are subject to risk, including the loss of principal. Now we got that out of the way. Just a couple other quick points. Those of you who've seen me before know that I love it when we have a dynamic back and forth with our audience. If you're in Palo Alto, get Marty's attention, he'll get you on. If you're on the webinar, then as they like to say on the podcast, smash that chat button and fire away. There's a finite amount of time, so I ask everyone to be mindful of that and be concise in asking your questions and answering them. That said, one-word answers are not very helpful. So yes, no, don't really give us a lot of insight. So feel free to elaborate to the extent that's needed to get the point across. I already gave high-level introductions of our panel, but I'd like them to maybe just take a minute or two, talk about their firms and their interest in emerging managers. So I'm going to start with Chip. And Chip, why don't you just take a minute, introduce yourself, talk about your company.
Thank you, Mark. I don't have a disclaimer as intense as yours, but you'll find one on my website. Anyway, I and my firm are placement agents. We've been third-party marketers since 25 years. We have raised a lot of money for people. We are a registered FINRA broker-dealer, and I have 8 employees, all of whom are registered. Our goal is to find great managers and introduce them to institutional investors. Used to be across the globe, a little more difficult these days, but certainly in North America, we're registered in the United States and Canada, and look at all kinds of different opportunities, both in private equity and hedge funds.
Fantastic. What is the typical size of fund that you'd like to work with, or how do you, top level, 35,000 foot screening level? Why don't you give us, some little background on how you like to, the size of the funds you like to work with, and maybe the stage that they're in?
Oh, we love to work with people that are, in excess of $100 million and larger, because to interact with any kind of pension investors, you need to have $400 or $500 million under management and a track record of 3 to 5 years. We don't usually see guys like that. We usually build them to that. We have done everything from people that have $120 million down to, well, back in the 90s, it was a little easier to do somebody who had 12 or $13 million and bring them out. But today that's almost impossible. A lot of our investors are so large now from their successful hedge fund investing that it's hard to imagine anybody being able to write much of a check to a $12 million investor that's been at it for a while. So we look for people that have around 100 million and have a track record of 1 to 2 years, but that also is dependent on where they come from. Okay, if they're coming out of a well-known shop, if they're a well-known portfolio manager previously to launching their own efforts, that certainly bodes well when we're considering them.
Fantastic. Thank you for that. Mauro, I'm going to ask you to do the same thing. Give us a little insight into your background. Talk to us about SMC and Heidecke Capital, and just fill us in there.
Absolutely. I teach finance in Italy and Switzerland. I teach corporate finance. I work also with the European Commission in the venture capital area for discovering and investing in new technologies. I'm an equity partner of SMC, that is a family office with 15 physical presence in many countries, in particular in Russia, Middle East, Switzerland. We have some offices in Europe and in South America. In particular, we have a big office in Panama. I'm also an equity partner of Heidecke Capital. That is another company. It's an asset management firm. It's a new company. It has been established in 2020. And with Heidecke Capital, we have asset under management of around 50 millions. And we have funds in gold, one fund in gold, one fund in real estate, one fund in classic cars, and another fund on blockchain technologies. I am probably more on the demand side of emerging managers. It means that in some particular situation, we are interested in discovering this type of managers and having them to help us in exploring inefficiencies or local market opportunities.
Sure. Dagmar, you want to take a minute or two, introduce us to search firms and give us a little background on Novastone Capital Advisors?
Sure, Mark. Thank you for having us again, and hi to Marty, wherever he's in the corner. And greetings from Zurich, a town. When I look out my window here, I have at least 40 cranes. So we're much smaller, but we are, as far as building is concerned, par with much of what is happening in big towns in the States. Well, having said that, Mark, Novastone Capital is our family office, and it has decided that it is building out its illiquid private equity portfolio in Europe with the search fund asset class, in which it has more than 10 years of investment experience in the US and South America and in Spain. And the search fund asset class is, if you will, is really an investing thesis where, and the process, whereby you are not looking at the deal first and trying to find your operating partner, or if you like the deal, and figuring out whether you have the right operating partner in the house to actually grow value at the target. It is a process where you are in reverse, where first you are backing a, in the industry parlance, it's called searcher, who will seek, based on his or her industry experience and thesis, a target company that is always an SME in succession, and then acquire that company together with its backers and create value on behalf of its backers. And then at the exit, we're definitely managing towards the exit, the operating partner or CEO or manager, whatever you'd like to call it, for your internal portfolio analysis, then earns a carry. What is for us as a family office very important when we launched this program for search fund investing for family offices is that it is very clear that for family offices in Europe for sure, but also for SMEs in succession in Europe, unlike perhaps in the US, it is highly unlikely that they would engage with either of the two. The former family offices or investment offices backing with capital, and then business owners in succession with succession issues, that they would engage and sell in an MBO, MBI, their companies to perhaps very talented, but albeit quite young, without industry experience executive. So for us, if you're talking emerging managers or operating partners, it is very important that they have industry experience, that they have a niche, that they have a particular view on the market where there is opportunities to discover, and that view is driven by their experience and having operated companies in that space before.
Fantastic.
And
I'm going to
having
just
said that,
cut you
yeah.
there a little bit, and we'll move on to Michael. Let him do a quick introduction of Running Point Capital. We'll get much more into this, as you know. Michael, why don't you take it away and tell us a little bit about Running Point Capital?
Thank you. I'll try to be quick. Hello, everyone, Bay Area and around the world participating online. Running Point Capital is a multifamily office. We are trying to be all things financial under one roof, targeting families, clients, business owners with 5 million to 200 million of investable assets. At that level, you have wealth, but you don't have enough wealth to create your own family office. So we provide tax and accounting services, bookkeeping, bill pay, insurance and trust and estate planning services, and of course, the wealth management. My background, I've most of my life been on the buy side. I did do some collateralized debt obligation, collateralized loan obligation modeling for Deutsche Bank, but mostly been on the buy side. A lot of our focus, once we move beyond getting equities and fixed income invested efficiently, is our focus on illiquids, private credit, private debt, private equity, venture capital, secondaries, and real estate.
Fantastic there. So how many family offices are involved with Running Point?
Well, we're really structured more like an RIA. So we've got quite
Gotcha.
a few families, and we are able to take on more, like I said, asset amounts of 5 million to 200 million. Gotcha.
Beautiful. So Chip, I want to start with you, if you don't mind. And it's going to be the question we did in our as we got prepped for this. And I'm going to ask you what an emerging manager is. What is it that makes an emerging manager appealing to an investor?
You remember what I said? No.
I do.
Darn.
I'm seeing if you're consistent now.
No, we'll see. Anyway, it's a moving target. What is an emerging manager? As I said yesterday, if you're a pension fund, an emerging manager may be, $10 billion in a 10-year track record. Whereas if you're a hedge fund investor, it may be somebody under $25 million and no track record. So it just really depends on what you're looking for. But I define an emerging manager as someone who is new to running their own business as a hedge fund, and who probably doesn't have much more than $50 million under management at the time that they launch, and in many cases, a lot less than that. They are usually ones that have the best performance because they have something really to prove. And they work incredibly hard and are watching everything all the time. I find that emerging managers are a lot more exciting than some of the more established managers. Many managers that are running north of $1 billion find themselves somewhat removed from the actual investing and or day-to-day operations. They've got COOs and CFOs, picking the pieces and doing a lot of the work themselves. So I find that an emerging manager is a much more exciting place to invest and look for opportunities.
Yeah, I think Kauffman Foundation ran a survey 10 or 15 years ago and found a finding very similar to what you just said, that oftentimes the first and second funds of managers are the best performing because they have so much at stake. And the numbers tended to prove that out. Mauro and Michael, you just heard Chip's response. From your perspective representing families, do you specifically get mandated to find emerging managers? And if not, how do you wind up with emerging managers in your portfolio? What attracts you to them? So.
Well, maybe I can start. Okay. Well, in my opinion, it's important to use emerging managers when you wanted to explore local inefficiencies, or where you want to find local expertise. And in that case, I think that the emerging manager is really giving you an advantage. And I totally agree that he has something to prove. So let's say you reduce a lot the agency problem that you might have in other cases. I was reading also a couple of days ago a research, an academic research dated 2010 of real estate investment trust, and there was, for example, a negative correlation between the size of the fund and the performance. But yes, in general, I think that the emerging manager is giving you an advantage in some specific markets. Where, for example, the expertise, the local expertise, it's really a matter of outperforming a traditional fund. And in that case, the answer to your question would be yes. In that case, I think that it makes sense to give a mandate to find an emerging manager, because clearly the problem on the other side is that the due diligence can be costly, and creating a relationship of trust with an emerging manager takes time. So you need really to balance these two elements together.
Fantastic. Maybe you could just give us an example of a recent manager that you invested in, how you sort of came across that person, or shouldn't say that person, but that group, and what made you decide to go with them. Maybe that'll help crystallize a little bit. Then we'll get Michael's take on this.
Yeah, the example, it's about a restructuring that it's a real estate restructuring that we are conducting in Italy. And we really needed a manager there with the local knowledge and expertise of that market. And we got in contact through, actually it was not so difficult, but through our branch in Milan that put us in contact with a scouting company, and they got us to this let's say industry expert of this area that it's emerging manager in Toscana for real estate and that type of assets that we are trying to restructure and to acquire.
Fantastic. So it was really built around that need to have somebody in Italy who had that expertise and could really help get you to where you needed to be faster than you'd be able to do on your own.
Yeah.
And fantastic. Michael, you want to chime in here and maybe give us your thoughts on this?
Sure. I think Mauro was spot on. An emerging manager can really help out with local inefficiencies, local expertise. He's 100% correct. And right along those lines, they can also help out if it's a small niche or early days. Think back, early days of crypto, Bitcoin, blockchain, cannabis. You didn't have big managers in that space in the early days. So if one wanted to be early, not that we played in that area, but that's where an emerging manager comes in. Similar to what Dagmar says, what I usually look for is someone who's very smart, because we don't want dummies, but not only do they need to be smart, they need to have a niche, an area of expertise, preferably one that's hard for us to access. But the third thing that I tend to look for and like is someone that walks in with process and structure already in place, because I don't want someone to have to figure out process and structure for their company and investments, either on my dollar or my client's dollar. And so sometimes in the past, we have seeded a couple of emerging managers, but they were already within a large structured investment firm. And that firm wanted to carve out a fund specifically for them, specifically for a niche, but the managers already had the system and process in place, as well as the intelligence.
So do you walk us through that example a little bit about how you found that manager for them? And how did you get, I'm going to get into due diligence in a few minutes here, but on the front side of this, how did you check to really make sure they had those processes and things in place, especially with an emerging manager, maybe doesn't have a lot of history behind them?
So as I mentioned, this was a really special niche. And in both cases, there were 3 funds we helped invest in. 2 of them we helped seed. But as I said, they were part of much larger firms, one in New York, one in Boston. So we were already familiar with the firms. I was familiar with the firm. In a couple of cases, I was already familiar with the manager and had spoken to them several times before on previous funds. And the due diligence was really understanding the paperwork on it, reading through all the documentation, understanding exactly what they were going to do, what the risks were, and what we would expect to get for our clients.
Fantastic. Dagmar, I want to come to you now and have you just, you were talking a little bit earlier, you were saying how you go out first and you find the talent and the talent searches and find the opportunity. Take us through that process a little bit. Maybe, I think you believe you recently found your first US person. Maybe I'm misspeaking. I apologize if I am.
It's a lady, so.
A lady. So yes, why don't you fill in for us and tell us how you found her, what attracted you to her, what made people get excited about what she had in her mind and what she wanted to do? Sure,
I'd love to, Mark. Again, we are not managing anybody's money. We are really running a program, and our members are family offices or investment offices, Swiss, international, and now also North American, who are, if you will, have either would have loved to become more active in the private equity space, direct space, and have become a bit disenchanted with the vehicles that they have engaged with, or have always passed on opportunities that have come across their desks because they had issues, as my colleagues here had said, with, okay, how do I analyze this? How do I decide? Well, everybody talks to you about upside, but in the end, it's really, if we're honest, how is this person not going to lose my money down the road? And how can I test the thesis? And so what we are doing here in our program on behalf of our family office and our members is that we've really developed, if you will, a turnkey solution. And the first one is to find our searchers or our managers. And today, at the end of this month, we started last summer with this program in Europe. At the end of the month, we have 15 searchers or managers, if you'd like to say, operating partners under our belt, and in Europe and in North America. And for that, we have our own assessment cycle. And for 15 searchers, and I just checked back with my colleagues, they've looked at more than 4,000 CVs. We have our own screening process. It's about 4 or 5 steps, 3-4 months long. And at the end of this process, the candidates have to convince our advisory committee to recommend to our family office to go in as the lead sponsor into their cap table. So what, and we've done this all virtual. We started the program virtual. We launched the US all virtual, and it is possible because what we are looking for our portfolio, and our family offices are looking for their portfolio, is obviously industry expertise, but it is and acumen in finance and whatnot, but it is fire in their belly. It has to be a very strong view on the market. And it has to be their decided willingness to step out of a perhaps quite comfortable corporate career, because they have all been C-level executives before. And they know stepping out, very much so in Europe, perhaps somewhat less in the United States, but if you step out of your corporate career and you go out on your own, you must succeed. And they want to succeed, and it's their one in a lifetime opportunity to succeed. And this is what attracts our members to back them. What it also allows our members, what have been mentioned here before, is to, because we bring our searchers with decided industry expertise and view on certain markets to their portfolio, it is that they can look into niches with expertise, and they have opportunity to exchange among other members in the cap table who may already have geographic or industry expertise. So it's a push and a pull. It's very fascinating.
No, it sounds very fascinating. I'm sure a lot of people want to talk to you and chat with you about it. We'll circle back.
Hopefully,
again.
We'll see. It's a bit of a push and a pull, of course. And maybe one last, if I may. So
Sure.
With having said that, our average closing table on cap tables is, a closing time on cap tables is about max 6 to 8 weeks.
6 to 8 weeks. Okay. Fantastic. I somebody threw in a little color here, so I want to get to it. Alan Reed threw in that CalPERS had a mandate out for small cap managers, allowing them to get access to that group of small cap managers that offered potential. So what they're looking for was potential, sizable outsized returns, as opposed to the challenge of getting a sizable allocation to a proven manager. So some interesting color there. Thank you, Alan, for that.
Mark, can I jump in for a second?
Sure.
So if you think about it, if you're CalPERS, your allocations are large. You typically look for, in small cap space or some of these other asset classes that are constrained. You look for managers that have a lot of assets, because you don't want to be more than 10% of their assets.
Right.
You want somebody with a strong track record, and you want to negotiate aggressively on fees. Well, those aren't all, those are mutually exclusive, if you will. So if you're a small cap manager and you have hot numbers, you're not going to want to, even for CalPERS, you're not going to want to work for free. And so what they did with Legato, and this was made famous with a recent House subcommittee conversation, is Legato focused on emerging managers, as they describe, with people of color. And so they allocate across small cap managers that have yet to be proven or build the size. And so in that way, CalPERS is able to use their clout, get a lower fee, get access to alpha creators, and get size. So, you know, in looking at it, that's how they, through Legato, have envisioned a small, you know, basically allocations of small cap, but it opens up interesting opportunities, and many large pension plans have similar programs underway.
Yeah, and this is their latest iteration of trying this. They've tried several before, and some have worked successfully, and some have gone by the wayside. But no, it's always good to get that color, and thank you for that, Alan. I want to go back to Mauro and Michael, because, you know, about 2 months from now, you're going to get a phone call, and it's going to be Chip. Chip's going to be saying to you, you know, hey, I've got a great new fund. They've just come to the market, but because you had, because you guys had developed such a great rapport on this panel, he wanted to give you guys early looks at this group. Tell me what questions you would have, and what would your due diligence process look on this fund manager that Chip has brought to you?
First of all, Mark, why am I going to wait 2 months?
I was just giving them a thought that you might give them a day or two to breathe. I don't think you will. I think you'll bring them any good fund manager that you have in your back pocket there that you're working with, and things be appropriate for their portfolios. So, good question. Mauro or Michael, one of you want to field this? Mauro, why don't you go first?
Yeah, well, I think that I would go for 2 different strategies in looking for an emerging manager. The first one is when I need the local expertise, and then in that case, I'm looking for maybe a small, flexible local team, and probably I would have some question about their expertise, the experience, the track record, and I would try to have an idea about how strong they are, and clearly with the premise that I believe that in that market there are some inefficiencies that I can try to where I can try to an exploitation, and in that case, as I said, I would go for that type of question. The other possibility, and in that case, would be Chip that is going to suggest me if he has this option, is about seasoned group of people that maybe they have worked together in another company and they are starting a new venture. And in that case, I think that I'm aiming or I'm betting on the fact that they are highly motivated to start a new wonderful track record. And in that case, I would like to understand more about their history, why they are together, why they are doing this, what they have done in the past, and so on. The last option could be probably some managers under the radar, and in that case, they may have both a cohesive team or a good track record, but they might miss some requisites about the governance or a standard structure where to invest. In that case, would be interesting, but I mean, I think that it might be balanced with the time required to build the right governance structure in order to make an investment.
Yeah, let's just throw in, because you do a lot in the digital asset world. So if this were a blockchain or a crypto fund or something like that, would there be any additional steps or anything you might do a little bit differently in that space?
Well, I think the base, it's the base of the theory. It's similar, but clearly it would be applied in that specific sector, and probably it's it's not an easy sector because the due diligence, it's very difficult because the track record is so small. It's a young sector. So probably it's much difficult there than probably like in real estate where you have a long history and you can also ask to other people and you can easily provide and check somebody track records. I have also to say that in blockchain and digital asset, we have in-house experience because we have, it's like more than 4 years that we have been working also as consultants in this sector, and we have built a platform and that has recently received positive compliance feedback from the authority. So we have a platform where we can trade in a primary and secondary market security token. So probably I could be the emerging manager of someone else that is trying to enter in this sector in that particular field.
Thank you for that. Michael, you want to take a crack at this now?
Sure. I like the range between Mauro, who's more of a single family office, and us, who are registered investment advisor, multifamily. The demand is rarely ever client driven. What I mean is I've never had a client come to me and say, Michael, I really want to pay 2 and 20. Can you find me something? Or I really want something that's 10 times levered. Can you find me something like that? Never happens. Also, I've not had a client say that I want a blockchain fund. So really the ideas come from us and then we present them to the clients. So that's kind of how the idea generation
So is
comes.
that part of a longer term strategy you have for the family? Like you think they need to, be more in certain areas, so you advise them, then you go out and search for them? Or is it more reactive, people coming to you with various ideas, or is it a little both?
It's not reactive. Like I said, it's rare that the client comes to us and says, I want 2 and 20. I want to pay 2 and 20. Or it's rare. Never has a client said, I want a blockchain fund. Or never has a client said, I want a fund that's 10 times leveraged. It just doesn't happen. So we have to find and source the ideas.
Yeah.
Yeah.
Chip, I think, was going to ask what I was saying.
Yeah.
It's not so much I was asking about the family saying they wanted you to find, but do you, once you're advising them, do you then search out to find these? Is that what you're going to ask, Chip, or were you going to ask something slightly different?
No, it's,
I was going to say that.
I find something. First, I find something. Once I find some things, then I can present that to clients.
Gotcha.
But I don't present an empty, I don't go to clients with an empty idea. And then they say, because if I do that, they say, yes, I want that right away. And it's going to take me a few months to find it. That's not a good model. I need to find it first. That creates frustration for our clients. I need to find it first and then present it to clients. And if, and I know our clients well, our firm knows our clients well. So we know what we're want to gear them towards.
Great. Chip,
what was your question?
Did that ask?
More of a statement. Not all hedge fund managers are 2 and 20. Many, in fact, are much less than that now. That's number one. Number two, they're not all leveraged 10 to 1. Many of their net exposures are much lower than that. In fact, lower than the S&P often. So generalities about, small managers or emerging managers or hedge funds, clearly you're not going to try and bring that to your clients.
Chip, I wasn't implying that your hedge funds, I wasn't meaning to imply that your hedge funds are levered 10 to 1. I was just going back to, a couple of the managers we seeded back at my old firm were levered 10 to 1. And we brought those in-house, or we brought those into the investments. So I was being very specific to us and examples, but we'd never have a client ask for that.
So you were about to go into a different area there, Chip, and then I cut you off and asked the question. I'm sorry, not Chip.
Michael.
There we go. Michael, thank you. Apologies. Michael. So you're about to go in a different direction. Did you fully get out all your thoughts, or is there something more you want to say before I move on?
I think I got out enough. I was just going to try to answer your questions if Chip was to approach me, which was your original question.
Sure.
But, I mean, if Chip approached me, I mean, he seems good. He's got a good track record. I now know him from the panel. I take his call or email. The first thing I do is I'd say, send me the deck, and I'll look at the deck. And, nothing against Chip. Most things I look at, I don't do, but I will look at it to at least know what's out there. And if I can, I'll try to provide him some feedback, because I want Chip at the end of the day, he may have 7 funds he's representing. And if one of them happens to fit me, then I want him to show me that, or,
Absolutely.
So Chip can be a filter for me.
Gotcha.
That's what we do. I mean, I think that's a great statement for, any kind of marketing organization, Michael, is that we are a filter. We're doing the first due diligence, and we can't afford not to do solid due diligence on a manager, because, if I bring you some piece of junk, you are going to tell more people than just me no. So, our responsibility is to bring high quality individuals and clean track records to the forefront for people to potentially invest in.
Having some experience in your business there for 10 years, Chip, I can tell you that if you've taken a dud, you may never get a conversation with that organization again. It's very hard to dig yourself out when somebody does a bad job. But I want to switch over to Dagmar here just for a second. Making the investment is clearly the first step, and your search company goes out, they find their target. But once when they make that investment, how do you work with the manager to help ensure their success?
One way the system is obviously inherently built into our program, in that we look at it just as your general type of portfolio management duties that you would take on if you had a major stake in any type of an acquisition. So you would want to track them closer. You want to be informed. You would want to know what they're doing, and you definitely want to want them to come to you when they have a problem, when they see the problem, and not after the problem had occurred, and then they are in a corner at a dead end, and nobody has a good idea how to get out of it. However, with this model, with this type of investing inherent to the search fund asset class, you have not just one backer, you have 15, 16 backers, perhaps. And what we are aiming for in our program is that we would like largely our program members to be able to engage with their managers based on their interest in the industry vertical or in the geography. So to be a sounding board with them, to be also to show them opportunities that they might pursue, both in opening up new markets or for add-on acquisitions and whatnot. So our managers have, or our searchers, when they're CEOs, they have a very large a group of experts behind them who are very interested in their success. And we believe that with that backing, specific type of backing, family offices that are typically continue to be entrepreneurial, have businesses in their background that they're running, plus the support of the program, that should be an optimal combination to for the CEOs to succeed.
Yeah, I think so. I mean, it makes a lot of sense. You got a lot of expertise in your investor pool. You got a lot of expertise in your talent pool that you're bringing in these new managers, and it just makes a lot of sense. They work together here. Now we have a big, long discussion going on the side here, and it's really the area I wanted to wrap up. And it's all around, I'll say terms and features of funds. So Chip, I'm going to throw it out to you just sort of get this started, particularly around fees and negotiating between the LPs and GPs. If you could maybe just talk a little bit about where the battle's being fought today on that scale. And we'll just start there. So you want to fill in?
Yeah, I mean, look, when I started in the business, the fees were 1 in 20. A little guy named Stevie Cohen, he had different fees. They're like 3 in 50. People will kind of take what they can get or earn, but at the end of the day, you're not going to get every investor if you're 2 in 20, unless you're performing at 20 plus per year. What we recommend to our managers is a reasonable liquidity, that if you're a long short equity, you don't have 1 year lockup. You may have a 30-day notice and 60 days, depending on what you're investing in. On fees, well, you don't want them to not be able to get good talent as they build out a business, right? So it's kind of hard to run with the expense of compliance and everything else on a 1% fee these days. But most people can run on 1 1/4, 1.5, unless it's a big quant shop or going to be a big quant shop where you've got a lot of expenses associated with that. But what I recommend to our clients is have a reasonable management fee. And what's reasonable? That depends on who the investor is. Is it 1 1/4? Is it 1.5? It may even be 1. But earn your money through profit participation. So maybe you're 1 1/4 and 15 up to X percent, and maybe you have an 8% hurdle or a 3% hurdle. Or again, it all depends on the clients. But if you get to a double digit or a triple digit or whatever, you get more of the incentive fee, and maybe it looks back. So if somebody's target return is 15%, once you've returned the 15% and you exceed that, maybe you're getting, instead of 15%, you're getting 20 or 22 or something like that. People want the manager's interests and abilities aligned with their own. People aren't afraid or unwilling to pay if you're earning them a lot of money. So that's the recommendations we make to our clients.
Sure. And are there other issues besides just fees and expenses that are negotiated?
It depends on the size of your investment. It depends on a lot of things. Yes, things can be negotiated, but there's usually a letter agreement, and most people want most favored nations when they're investing the same amount of money. We do not get involved with people that are on a seed platform, primarily because it's too hard for a manager to pay me, pay the seeder, and pay his people and make a couple of bucks himself. So people have to really choose. Do they want to have a marketer, or do they want to have somebody who's going to take 25% of their hide forever or more, depending on the amount of money.
Understood fully there. Mauro and Michael, I wanted to throw this out to you and see if, when managers come to you, what do you negotiate for? What's important to you? More on the LP side.
Well, the first thing that I would try to understand is about the amount of diversification that I can get with that manager, and this is probably one. Clearly, it's very different if we are speaking about the real estate sector, or if we are speaking about assets that are traded. So we are speaking about equity, and if we are speaking more about equity, I would try to understand what is the beta of my portfolio. After that, I'm going to get a piece of that fund and a piece of that, let's say, investment in that new vehicle of the emerging manager. And that, I think it's very important, because in that case, it means that I'm aiming for a niche, or I'm aiming to get a a specific strategy that I can find just with that emerging manager. So if I have this, then clearly I'm interested, and we can try to negotiate. And I totally agree with what Chip said about fees.
And let me ask you, when you're dealing with a private equity or real estate, are co-investment rights important to you?
Yeah, absolutely. Co-investments, it's a way to share risks first, and it's also a way to share expenses, like if we are thinking at the due diligence or other type of expenses.
Michael, you want to chime in here a little bit? Give it from the, the combining a bunch of people together. I don't know if you do that in SPV or if you do that just individual investors.
Hey, Mark, we gotta wrap up soon, so.
I understand. I saw, this is our last thing, and then we'll call it.
It depends. I mean, yeah, I'll negotiate on fees. I care more about management fees than performance fees. I'd much prefer to whittle down the management fee than the performance fee. Like I mentioned, we've done 3 emerging managers. One of them had a very low management fee and actually no performance fee. They were just really looking to build the track record and get their toes in. It was hard to pass up. The other funds that were 10 times levered, no management fee, it was all performance fee for the risk that was there. That made a lot of sense. Recently, we, did another fund and got the management fee a little bit lower. That really benefits our clients. And over the long term, that savings compounds.
Well, I want to thank everybody. I could see Marty is standing by patiently. Dagmar, a terrific job. Once again, Michael, thank you so much. Chip,
Thank you, everyone.
Mauro, you guys were all fantastic.
Thank you.
Thank you.
Thank you, guys.